started. All right, yeah, let's get started here. So the S&P is pulling back into support. We lost support number 1, we lost support number 2, but as you can see in the yellow, right, S&P 500, we're pulling into that 431 level. We have some good news and we have some bad news. All right, we have good news and bad news. Let me know if the echo is terrible, if you can hear it, whatever. Hopefully the mic is working correctly. Good news and bad news, right? And let's go ahead and start with the good news. But you see that support level. We are holding the trend. We'll get into this a little deeper. All right, I want to make sure we can see. So good news, bad news. We're going to go over this macro. You know, really it's technical. What is the good news about the stock market, right? The crypto market. What is the bad news about the crypto markets? What are the good and bad news about the economy? What is the good and bad news about policy? What is the good and bad news about the financial markets? That's what we're about to hit today, this evening on Saturday, and run through why you should be fearful and why you should not be fearful, right? And I'll leave you with the conclusion. What should you do next? All right, so good news, bad news. First off, the bad news is, let's start with the bad news. You always want to start with the bad news first, right? Psychologically, the bad news is blame the correction on seasonality. Historically, September is the worst month of the year. As you can see on the chart, if you go back to 1928, September is the worst month. And really, July is the strongest month seasonally. And then you go into September. So you really peak out in July, right? I wish they would have showed us this data before the sell-off. Then we could have sold the rally and bought the dip, right? But that's not how the market works, right? These are all correlations. But for the most part, you know, everybody's looking for this dip. It's psychologically, it's playing itself out. We are correcting. But I think because everybody sees these charts, you know, people are going to stop selling because they're going to look to buy. Fearfully, they think, okay, if I keep selling, maybe we'll rally and I'll get screwed over, right? But if I do wait, I'll wait for the bottom to come in, and that stops the selling. And then buyers jump right back in. We know the good. I'm not going to get to the good news. If it's so tempting to get to the good news, we're not going to get there yet. The recent rise in long rates. Okay, next. So seasonality. Okay, this is September is traditionally like it's a, you know, like you're going, you know, like a tradition. September's the worst month. We all know that. Okay, keep that in your head. That's actually gonna. You should be licking your chops. Oh, this is the worst month of the year. And then after September, we go up from here. Okay, let's see if the macro aligns with that. All right. Now, the other big threat here, US 30-year yields or 30-year rates, right? The benchmark rate to the housing market, to the stock market. Well, it's the 10-year, but this is the bench. These are basically bond yields are basically the rates that set for that set the mortgage rates. They set the rest of the market, right? And they hurt two things. Well, I guess we'll go through this. The recent rise in long rates is threatening mortgage demand, okay, because 30-year yields are the borrowing rates for housing, okay? Not the actual yield, but it's based off the 30-year. So if the 30-year jumps 0.5%, you're going to see mortgages jump 0.5%, right? Or at least move higher to some degree. And 30-year mortgages are now pressing 8% rates because of this yield. It's not happening on the short end, it's happening on the long end. What does that do? It threatens mortgage demand. If rates are so high, obviously nobody's going to buy. It's too much. You're sort of sowing your losses into the future because you're going to be paying 8% interest for the first 10 years on a house, right? That sucks. Also, it affects stock earnings, mostly long duration assets. Why does it hurt stock earnings? Because stocks are valued off of valuations to the future. Not right now. They're valued off of interest rates. So if you're a professional analyst and you're using 30-year yields or 30-year rates to discount, well, let's not talk fancy here, to calculate the earnings of a company, well, if the yields rise, that's like you're paying a little tax, right? You're paying a higher interest rate to borrow money to fund your business. So this hurts long duration assets like crypto. Because crypto don't have earnings, but they are measured off of what rates will be into the future, okay? And companies that are more technology, biotech, right, very risky assets are more based on longer rates. So they're going to have trouble here if it goes higher. But there is, okay, I don't want to say the good news. The good news is, I'll sneak it in. The good news is maybe this is the peak. But that's not really good news, is it? Right? I'm going to get to the comments here too. What up, Bukowski? How you doing? Big man's coming. I see all you guys on there. All right. Higher rates typically result in increased bankruptcy. So as these rates continue to rise, and we're getting the 10-year yield rise, we're getting the 30-year yield rise. You hear that baby? I don't know if you can hear it. He's crying right now. That is my nephew. Must have just woke up. He's about 5 days old. So that's why I'm out here traveling. Anyways, back to the macro report, right? The negative effects of higher cost of capital continue to rise. So this is a combination of two things that would cause bankruptcies, right? And bankruptcies are not good, even though they might be good, because if you get too many bankruptcies, the Fed might actually cut rates. They could actually cut rates if you get too many bankruptcies, right? Maybe just 25 basis points, or maybe they just pause, but it's still on the table. It's still in the pocket here, right? So if long-term rates are rising and the Fed keeps, hiking rates 25 basis points in September, then we could see some more bankruptcy. So that's on the table here. But what does that spell? Is that terrible news? Well, it is if we're talking big banks. If we're talking big banks, it probably is terrible news. And we'll keep our eye on this to see what happens further, okay? Equity credit risks on the rise. Now, this is more the stock market here, okay? And when I look at the stock market, when you look at the stock market, there is equities, stocks, same thing, right? Same name, equity stocks. And they have a credit line. Basically, people buy the debt of equities of stocks. They buy the company debt. They get a yield from it, right? And the more that they buy equity debt, you're basically confident that these companies will survive. You're getting an interest payment from it, right? If you buy the government's debt, they're going to pay you no matter what. The government debt is going nowhere because they can print unlimited money. But equities are more risky, right? So we look at the triple B credit spreads here between treasuries and equities, between stocks and the government, basically. So when this credit spread rises, you see that giant rise back here. You see this rise right here, right? This was COVID. Why? Because the economy shut down. So U.S. Treasuries got a bid, and that was the bid on U.S. Treasuries. That was the bid in government debt. It was, obviously growth collapsed. What are you going to go invest in Target? Nobody's shopping there. Their earnings are getting crushed, but you can invest in the government because they're going to pay you no matter what. So that was that spike. And every time we spiked, the stock market rolled over. All the arrows are showing us the beginning of credit risk rise, right? Credit risk rising. We're seeing the credit risk rise, right? So today we're starting to see that. Now, we haven't fully developed yet, so don't get too excited if you're a bear, right? Don't get too excited, but they will signal, oh my God, credit risk is rising. They're going to signal to you that, right? Seasonal weakness. Well, you know what? We're going deep. It's not just September. We're going deeper. 30-year yields going to all-time highs. It's going to crush real estate. We're going to go into another housing market crash. Everyone's going to go bankrupt. Credit risk rising. So the max bears love this chart. They love this chart. But if it rolls over, who cares, right? New York manufacturing pukes again. So the manufacturing index manufacturing is the economy is made up of two parts, right? You have the service economy, 70%, consumers, and then you have manufacturing. Right now, manufacturing has been weak. It's been recession territory. I think it's starting to bottom out by September. I think we start to turn up a little bit. Maybe by the end of the year, December, we actually go back into positive territory. That's what it's looking like. And we'll get to the good news here. But the New York manufacturing puked again, right? And that's what the bears will say. Well, look, manufacturing is not recovering. It's puking. We're going into a deeper recession. You're going to get layoffs. Unemployment rate is going to spike. Payrolls are going negative. Okay, until I see it, right? But it is still there. We are seeing that. Okay. Now let's go ahead and debunk, right? That's just the bears. That's what they say. But I'm going to go ahead and debunk why these risks are not as bad as we thought. Before we get there, I'll hit some of these comments. Let me make sure I didn't miss any former comments. We have, what happens to the SPY? You think we're going down on Monday. If you jump on YouTube, we are showing the technicals. I will go over the technicals. Actually, I have the technicals in this report. So I rather you see the chart than me just tell you, is it going up? Is it going down? It can go up and down in 5 minutes, in 1 hour, and 15 minutes. But what is the trend? Where's support? I'm going to give you the technical support of the S&P, the actual technicals as far as moving averages, as far as relative strength. There is a reversal signal that we're going to go over. So stay tuned, okay? First off, debunking the equity credit risk. More than 75% of corporate debt, so we're talking about the debt, right, is monetized at a fixed rate. Meaning, even though the Fed keeps hiking rates, it's not hitting most of the debt. Yes, some of the debt, but it's not hitting a lot of the debt. Okay, for equities, most of that debt is fixed. So if they locked it in at 2.5% and the Fed keeps hiking, it doesn't affect it, right? It doesn't affect. So that's a positive catalyst there. When they say, oh, the equity market is going down, the credit risk, sure, credit risk can rise. We can get some volatility, but most of that debt is fixed. Just like if you locked in 3.5% interest on your house, right? And the Fed raises rates. Well, you're not affected by the 8% mortgage rates, are you? Because you already locked in 3%. Okay. Thoughts on home builder sector going forward? Looks like it might start to roll over. It is starting to weaken, Bukowski. It is starting to weaken. We will go over those charts. I'll come back to that comment. All right. We'll get back to that. So almost half of equity debt won't need, and you need to know, if you want to learn more about the market, maybe you don't care. You just want to know, what should I do, right? But look, I'm going to educate you. I'm not just going to tell you what to do. That makes no sense. Everybody's situation is different. Understand this so you don't get tricked in the future. Understand this. Maybe you could turn it into a career, or maybe, you know, my hope is in the future that they teach this in school so we can be more financially literate. Okay. Almost half of equity debt won't need refinancing until 2030. So what this shows is, and this isn't half, but 46% of equity debt. So the stock market debt doesn't even mature till 2030. What does that mean? Okay, rates are at 5%. Well, it doesn't matter because we just saw that most of that debt, a lot of that debt is already fixed. If that fixed rate doesn't change, well, not all of it, but a lot of that fixed rate will not have to refinance until after 2030. So rates don't matter right now. Maybe they come back down in 2025. 2026, who knows, right? So we'll get there. But anyways, it's not a big risk. If it was like most of debt is going to expire in 2024 and rates are at 5%, yeah, you're going to get a big derating, devaluation in the stock market, because that means that interest rates are going to fly for the market. Okay. Anyways, let's get back to it. All right. Corporate profits. I don't see any more comments. Corporate profit costs, right? Corporate profit margins, which is basically how much money you're making versus your costs, okay, are virtually unaffected by rate hikes. So this is corporate interest costs as a percentage of profits, and then against the Fed funds rate in blue. You can see that the costs are continuously falling while the Fed hikes rates. Well, what's going to happen when the Fed cuts rates? That's going to push them even lower. So really, we're seeing a very resilient stock market. And that's why the market has been chugging forward. It's been very resilient. A lot of people are confused. The economists don't know what's going on here. But that's why we keep up with this data every week. That's why I have a macro report. You should go subscribe so you can learn more. Because if economists were so right about what was going to happen, if they just tracked the economic data and they think, oh, I know what's happening, they wouldn't be economists. They'd be rich. But they're not. Because there's more to the markets, to understanding, than just the economy. There's more to the market than just the technicals, right? You got to add the fundamentals, earnings, margins, right? You got to add the technicals. Okay, technical analysis, and people, oh, it doesn't work. Okay, well, it does work. I don't know what you're talking about. And then you got to add on there the macroeconomics. So we are going through all of that weekly, on a weekly basis. Go subscribe, link in the bio. It's free in the description. All right, good news. Now let's get to the good news here. Let's get to the good news. The good news is the bull market trend is still in place. Technically, S&P is setting up for a reversal as it nears oversold territory, approaching S3 or support number 3, right? The same goes for the Nasdaq and most of the equal weighted averages. And we're going to jump onto that, right? So what I got here is basically at the bottom, every time we got oversold, the RSI was down under about 30, somewhere at the bottom of the RSI. RSI is about buying pressure. So if the RSI is falling, relative strength index is declining, that means there's not a whole lot of buying pressure. But you get to a point where it's like a rubber band. Okay, the buying pressure comes in. We're almost at that point. Every other time that the buying pressure came in, we saw the bounce in the S&P, right? When we get oversold, we know at some point there's going to be a bounce. Now, that's not always the case in a downtrend, but we're not in a downtrend. Obviously, we're in an uptrend, right? So we're approaching oversold, and I think this is a reversal that we're going to be looking at over the next week or two, right? Maybe we bottom, consolidate a little further, and then we go higher. Maybe we do roll over, but you need a black swan. You need something terrible to come in the market. So the S&P is holding the uptrend, okay, and it's approaching oversold territory. And if we go to the relative, if we go to the equal weighted average, it's the same thing. I mean, we're not there yet. I think I'll hit it right after this, but I want to get through the rest of this report. No more comments. So the market is holding up. So what keeps this bull market going? Okay, right now the market is pricing in a pause, expecting the Fed to skip the September rate hike. Right now the market is pricing in a 90.5%, and this moves every day. This changes every day, but this was as of Friday at the market close. Basically, 90%, the market is pricing in a 90% chance of a pause. So this is good and bad. What it means is it's good that, okay, the market is expecting a pause. And what that does is it lowers the risks, right? Smooths things out. The market can bid higher, and only a 10% chance of a rate hike. But if the expectation changes, okay, if there's a surprise hike, that's going to become a headwind. Okay, I have that. I know it says tailwind, but that's going to become a headwind if there's a surprise hike. That's not going to be good. Okay. Do they cut? I doubt it. I don't think they're going to cut rates. Not yet. We're not there yet, but they can pause. There is a reason for cutting rates, and we're going to get to that. Right. So the market is pricing in a pause. Okay. Expectations. This is about expectations, over positioning, under positioning. If this comes true, the market is not going to sell off. It's going to stay where it's at or bid higher. We got to watch the price action. But for the most part, this is a good setup that could turn negative if we get a surprise. And we'll also keep track of this, because if it starts to shift, then we got to say, okay, the market is now believing something else. But so far, it's looking at a pause, right? Volatility, here's the other catalyst, right? And this is mostly this is what we're looking at here is the chances of a reversal, because we are pulling back in the S&P 500. So I think we get a reversal here, all right? Volatility has pretty much peaked in showing bearish divergence. The VIX can reverse in the next couple of weeks if there's no more surprises. And we already said there has to be a surprise. So you can see that the bearish divergence is price, or the VIX is climbing, but the buying power for the VIX, the buying power for insurance against the S&P 500 is falling in the short term. So this is more of a technical indicator. Does it always come true? No, but it is a probability that gives us an opportunity to see, okay, you know, the pendulum might be swinging the other way. Even though we see the VIX climbing, the pendulum is actually swinging the other way. Okay, it's actually swinging the other way. Now, if that changes, it changes. But for now, I'm expecting the VIX to hit resistance. You can see it's hitting that resistance level, right, where it consolidated all through 2022. So I think we get rejected. The RSI showing there's not really a whole lot of buying power. All right. Buying pressure in the VIX. The VIX is not exploding. It is just making a move higher because of the, yields are higher. The market is, people are collecting profits for one. They're probably hedging themselves. Number two, yields are up, and yields could cause some banking crisis, right? We saw a lot of the banks get derated. Their debt got derated because if treasuries keep falling, if the bond market keeps falling, then what you do is you lose your collateral falls, all right? And that's what the VIX kind of went up on, but I kind of doubt that continues. All right, next, the dollar remains the wrecking ball. So the dollar is a wrecking ball, okay? It's still in a downtrend. It is still in a downtrend, and we expect a reversal based on the downtrend resistance and overbought signals. So looking at the overbought signals, right, in the yellow, you can see every time we got overbought or got into that level, the dollar reversed perfectly, right, or in unison with the trend. So we're in the downtrend. We're reaching that reversal point. And remember, the dollar is a wrecking ball. If it goes up, stock struggle, crypto struggles, risk assets struggle in general. But when the dollar starts to roll over, you start to get a bid in the market. It doesn't mean the market has to go higher. It just means that's one of the macro forces, one of the variables that can become a tailwind if we roll over. So I think we're in reversal territory, and I think we go lower over the next couple of weeks, unless there's a surprise, right? It's always unless there's a surprise. Now, this one I love. This is the one I love. This is Bitcoin. This is the big Bitcoin, all right? Now, what we're looking at here is Bitcoin is now on the daily chart, the most oversold it's been on the daily chart since 2020, right? Since the pandemic, when it bottomed out, when it crashed and bottomed, the RSI hit, 18, somewhere around 18. This is the lowest the RSI has been, meaning the selling pressure accelerated, right? We haven't seen this for a while. So if we're touching that level, what happened last time we bottomed here, right? And the other part of that is we bottomed at 4K. This time I think we're bottoming at 25K. So Bitcoin is hitting a monster level. that 25,000 K level on an extremely oversold RSI. That's a nice setup for me. I love that setup because now you're coming into 25K after a very long year-long consolidation into the strongest level, and the buyers haven't really stepped in yet. This looks like a buying opportunity. I'd almost, I'd bet 80% chance Bitcoin bounces at 25. Remember, no surprises, and this is the low. 25K is the low. I know a lot of people don't agree, but I think 25K is the level despite any surprises. Okay, my cat can eat a whole watermelon. Okay, cool. Elon sold a lot of Bitcoin. Yes, SpaceX, he sold a lot of Bitcoin. There's also a lot of buyers, so that might be a catalyst, right? Elon could say, oh yeah, Bitcoin's, who knows? But those are not real catalysts. Elon sold a lot of Bitcoin. The ETF is the biggest catalyst. Any sniff, right? Any small bit of information that the ETF is gonna pass, it's over. When the ETF, I don't want to say it's over. It's over for the shorts. People are probably shorting it, but as soon as the ETF, right, the news gets better, it's like, oh, okay, Bitcoin goes up, it's volatile, but as soon as the ETF actually gets passed, boom, it's gone. It's gone. There's a 30-something trillion dollar retirement market to start grabbing those Bitcoins, and there's hardly no supply. The demand is going higher, and the supply of Bitcoins is falling. Supply, it's a commodity, okay, and it's a very niche, small market. So Bitcoin, when it happens, will outperform the Nasdaq. It's going to outperform most stocks, in my view. Most stock, maybe not Tesla, but we'll see how that works out. So I have to be up at this hour. Oh, what up, Yasin? How you guys doing? Give your comments on YouTube so I can see them if they stick around. If not, what up? How's everything going? Oh yeah, if you want to rewatch this, just jump over to YouTube. I'm live right now, so you can see that video, link in the description if you want to see how we started this. Okay, the U.S. economy, GDP. Right, now let's move over to the economy. This is a lot of good news. This is probably the strongest. Yeah, we are live on YouTube. This is probably the strongest data that I've seen. This is insane. I mean, I'm being a little exaggerative, but Atlanta Fed GDP model for Q3, right? What we're looking at here is that GDP is being revised higher based on consumer spending. And GDP is the mother's milk to the economy. So currently, growth forecasts just keep going higher based on consumer spending. So you keep hearing, oh, the consumers are going to slow down, they're going to roll over, but the opposite's actually happened. Consumers are strengthening. They are strengthening. And a lot of people say that's because, yes, credit cards are up, but so is asset income, right? If you're parking your dollars at a money market fund, and I believe we looked at this on the last report, it was Fidelity. Somebody, they're paying like 4.7% interest on short-term cash. So cash is paying you an interest, and people are getting those earnings, and they're spending or they're saving or they're buying the market with it. So it's funny. It's kind of it's a little ironic that higher rates are also resulting in higher liquidity or more cash into the system, because the higher interest rates are for borrowers, the less they might actually borrow. But the savers are benefiting. The savers are getting an income, a fixed income like a treasury, right? That's why I think cash right now is kind of replacing the bond market. You're getting that risk-free income. And other countries too, they're going to want to buy a bunch of cash. You think China, Japan, all these other big companies, you think they're not going to buy cash and let it yield them? What up, Yasan? I see you on there. AI sharing the live. Thank you. Appreciate it. So I think that's it. So GDP is going higher. Now consumers keep spending. Will it slow? Sure. But guess what? This is going to leak into Q3 earnings. Right now, I believe, if you've been listening to me or our newsletter, we say, hey, I think earnings have bottomed. We're in an earnings recession. If the earnings have bottomed, what does that tell us? That stocks are looking 12 months ahead. That earnings can only go higher from here. And there's two things that really push the stock market higher. Not really crypto. Crypto is one thing. It's kind of two things. But for the stock market is earnings. It is EPS. It is earnings. How much can you retain from your revenue? And it is monetary policy and fiscal policies. Okay, I see you, Slime Z. I see you, Manny. It is policy. And right now, policy is at the end of the tightening cycle. As we've been saying, it's at the end of the tightening cycle. It's about to start shifting down, but GDP is still going higher. So we're not really slowing down in GDP. So earnings, I expect to be revised up also. And that means all the bears who said that earnings are going to collapse in Q3, Q4, which is, August, September, October, November, December, they're going to be wrong. They're going to capitulate. Here goes wave 2 FOMO. Okay, the GDP was up. It's crazy. Fed doesn't like that. I don't really think the Fed doesn't like GDP being higher. I think the Fed doesn't like GDP being higher if productivity falls, right? Because what that means is you're producing less in the economy, but people are spending more. So that's what you don't want, because you might get wage inflation. You might get some inflationary pressures. But as long as supply and productivity is up, more people are working, the unemployment rate is low. As long as you produce enough, that quails the demand, right? That takes care and neutralizes demand. You don't really have inflation. This is why I also think inflation is going to eventually collapse. And we're going to get to inflation. That is also good news. So right now, the economy is booming, and that should roll over into earnings. Stocks go higher. All right. Here's just another canary in the coal mine. Philly Fed manufacturing sees. So the Philly region, right? The Philadelphia region, there's all these regions of manufacturing. We like to look at them in different spots to see, is there a rolling recession? Is it a full-on recession? Is it a half recession? And what we're seeing is in Philadelphia, in that region, for the first time, the manufacturing index or manufacturing went positive. So you're looking at employment, you're looking at new orders, you're looking at productivity, you're looking at inventories. When you add up the business cycle, when you add up economic activity, right, in these forward-looking indicators for the economy, you get the Philly Fed going positive for the first time in 12 months. I think that's a good sign. And we did see the New York went negative again, but hey, Philly's been negative the whole time, right? So we're getting a recovery in the manufacturing sector. Number 2, our next, retail sales are rebounding. Since April, retail sales are rebounding. This is the consumer purchasing. Here goes goods. Oh, goods inflation is coming back. Maybe, maybe not. Maybe not. We'll keep track of that. We'll see, because, new car sales are falling. Car inflation, used car inflation is falling like a rock. It's been negative for a while. So retail sales are booming. This all supports GDP, moving higher, and eventually earnings. Okay. Any comments? Let's see. Before we move, just the GDP comment. What up? How you guys doing? And I appreciate you guys sharing the live. Can the Fed cut sooner than expected? So this is this is actually the big catalyst. I don't see the Fed cutting rates unless we see CPI really fall. All right, unless we get CPI really fall. So if you guys missed the Fed minutes, the FOMC minutes, go ahead, check out the newsletter. It's free. Click on it. I got the FOMC in this one, right? The FOMC minute review, kind of what happened and why would the Fed cut rates. So what is the Fed actually seeing happen here? Okay, what is the Fed starting to see here? And I think before we get there, actually, let's go ahead and look at it. Let's take a dive in here. Maybe this will work. So let's take a look at the FOMC minutes, right? And this is part of the newsletter. So you're going to get this for free. Let me see if I can zoom in. There we go. See the words. Good. Right. So let's just run through this real quick. So this is basically the Fed. What did the Fed say? Because the Fed policy is very important. The market is right now listening to what the Fed has to say, okay, are they going to cut rates? Are they going to slow down? Are they going to be more dovish, meaning they're going to ease financial conditions, or are they going to tighten financial conditions? Are they going to be more hawkish? Are they going to have a tone that is more hawkish? Right now, we've seen their tone come down while their confidence about the economy is going up, and that's actually been matching out. Okay. Let me go through this. So mixed reviews. So basically, I'm going to just give you the translations of what we're getting for the FOMC minutes. This is what they've been saying. You can read it for yourself. Okay. The first part is more FOMC members are becoming dovish. Keep that in mind. Number 2, the upside risk for inflation is coming from oil prices. All right. And we're going to look at that. It's all coming from oil. If you watch the newsletters or the lives, you know that oil is so important. That's probably the biggest, most important macro chart in my view is the price of oil. Okay. Considering a pause. Okay. So they're considering a pause and maybe a skip in September. Some of the Fed members are doing that. Okay. Some of them are considering a pause and a skip, right? The market is pricing that in. Maybe not the bond market, but the stock market is. Okay. We don't want to overdo tightening. So now they're using their language. We don't want to overdo it. Does that mean September? Does that mean they hold? I don't know. We'll see. Next, rate hikes are hitting the manufacturing sector and goods inflation. So goods inflation is down. We've seen rate hikes hitting the manufacturing sector, which is why I'm so excited about the Philly Fed moving higher, because with the rate hikes, they're starting to recover. Okay. But the New York is getting hit, right? New York is starting to get hit now. It's kind of rolling around. Supply side inflation pressures are easing. Yes. Wage inflation is easing. Yes. And that's coming from CPI shelter. We know shelter is a lot of the supply side. Policy is working as expected. This is a really good report, even though people said it was super hawkish. I don't think it was that hawkish. We could hold rates longer as the economy expands. Okay, that makes sense. That's a little more hawkish, which means, well, we don't want to get ahead of our skis and try to cut rates because inflation is coming down and making progress. Let's see what the economy can do. Let's let the economy work its way through a very tight environment, a very restrictive growth environment. And if it's really resilient during that environment, we can hold rates. That's a super good, that's a strong economy. People are getting cash from their cash. I mean, they're earning cash from their cash anyway. Let's allow this to happen. What happens when Apple goes and parks $60 billion in cash in the money market funds and starts yielding $300 million, right, a month, or 30 million a month? That's insane, right? So high rates don't necessarily mean a super tight economy because of one factor, fiscal policy, because the government has been pumping and spending a lot, and consumers are spending a lot also. All right, next, bond market collateral is this is the biggest risk. Bond market collateral is falling, poses a serious risk to the bank balance sheet. So when you see the bond market falling apart, that means the collateral at the banks, right? The banks use treasuries as cash, but cash doesn't really fluctuate, right? But treasuries do. Treasuries have the biggest fall in history. So if they keep falling, then that means their collateral is at risk. That means it's almost like if your bank account keeps falling in the, and let's say your house, right? A lot of people borrow against their house. Well, what happens when you borrow against your house, but then your house falls by like 50% in a market crash? Well, all that money you borrowed, you're now going to have to pay it back, right? Because your collateral dropped, you have to default. You got to pay back maybe 30% of what you borrowed. So that's kind of what happens. They might default. That's the biggest risk there. Okay, let's get back to to what I see, or let's get back to why or how in 2023 rate cuts are actually possible, right? So right now, the biggest input to inflation we know is crude oil. This is the biggest input, right? And look over here, what did I say there? Responsible? Oh, okay, that's what I meant. I'm sorry. So the first arrow there on the left, right? You see the arrows going up. That is oil going higher. This is responsible for the July CPI. The market is reacting off CPI. And should I get to those comments first? I'll hit your guys' comments afterwards. Just keep leaving them and then we'll address them. You always so bullish. Well, hey, the market's been up for a while. I'll get bearish when the technicals change and when I see more macro risks, right? And everybody knows that my macro risks are oil gets above 83.50 and holds, the dollar breaks out, bond yields keep going up. That's when I get bearish. So yeah, that's when I get bearish. I still think we're headed for all-time highs also this year. And you can always tell me if you disagree, but tell me why. Don't just say I disagree. Tell me why. All right. So oil, right? It's getting rejected at that level. Now CPI went higher because oil was up 17.5% last month. So the second arrow, right? This is August CPI. This is what we're going to get next month in September. Right now, we're not really going anywhere. CPI, oil is flat. If it's the biggest input to CPI, oil, energy prices, and it's moving sideways, that means CPI is going to come down. That means the rate of change went nowhere. So you don't add points to CPI. Actually, CPI goes back to 3%, 2.9%. If we move sideways, I think we get to 2.9. But if oil drops, right, back down to the lows, which is very possible, I think the Fed's going to see that and say, okay, we can pause because inflation is coming down faster than we thought. Also, and I know you're going to focus on core, but also if it does break lower, if we break that $67 resistance, the Fed can cut rates in 2023. That's what I think can happen. Will it happen? I don't know. I'm not sure yet. We're keeping track of it. But I think it's possible. Right? And here's why it's possible. U.S. core inflation, if you remove shelter. Okay, this is the sticky of sticky. U.S. core sticky inflation. You remove shelter, remove housing inflation, remove rent inflation, and then you 3-month annualize it, which is a fancy word for looking over the last 3 months of core inflation data. It's almost at zero. It's below the Fed's target. So core inflation X shelter, right? Let's remove energy. Let's remove oil. Let's remove shelter. We're at the Fed's target. Very positive data there. It's only a matter of time before it comes in, right? And I'll get to your comments. I know I'm running through. Actually, if you let me hit the comments. I'm probably hitting. I'm probably going a little too quick for some of you guys. What type of manufacturing are in Philly versus New York? Good question, Bukowski. If I remember correctly, I think the New York Empire, I think they're like similar, but I think the New York Philly Manufacturing Index might include, I really don't know. I'm not going to lie to you. I just look at them as the same. There's probably some minor details that are different. I think it's the Chicago PMI, the one that's a little different. I think it's the Chicago one, but the New York and think of it this way, the New York and the Philly Fed, it's just more regional. You're just looking at the regional manufacturing, right? Coming into New York versus Philadelphia. They're pretty close to each other also. So no clarity there. One is going up, one's going down. But that is a good question, right? That is a good question. What you want to keep your eye on is new orders. Are new orders climbing or are they falling? The new orders is the beginning of the new business cycle. You might have employment dropping. You might have productivity dropping a little, but new orders go up, then we're in good shape. So I'm looking at new orders for the next ISM PMI, which takes a look at, I like to look at the ISM because it takes a look at the whole US, right? Looks at the whole manufacturing, adds up all the surveys in the US, and then it gives you one number. We're still in negative territory, right? But it is starting to bottom out since it's opposite. Okay. So I hope that helped you out. I have a question. Is it possible to look back at this live? Yes, it is. This live will go in, Yasin, as a video on YouTube, and you just click on it. You'll be able to go back on the live. You should be able to go back on the live. All right. Eventually, I'll do timestamps in the future, but you know it's kind of long. Where are we at with this? Let's see. Why can't I see the? I can't even see what time we're on. Hopefully, it's working correctly. Oh, it looks like you guys are on here. Anyways. I have a look at oil RSI on the daily. It looks like it's about to bounce. Yeah, oil is not done yet. Oil does look like it's going to bounce on the RSI. I didn't show it because obviously I want you guys to think it's going lower. No, I'm just kidding. But yeah, I'm just, oil's been pretty strong. This is a bullish trend. It's still in a bullish trend, but also it's in a bullish trend against a very long resistance level at 83.50, right? So you're right. In the short term, it is still looking pretty bullish on the RSI. And we just got to keep a track. We just got to keep track of that level, right? I think by the time we close oil, like over the next 2 weeks, if oil remains at the CPI is going to look really good if we remain beneath 83.50. It would have just moved sideways, and we'll see. And I think with China slowing down, China manufacturing not really picking up, I don't think oil has a bid there. Okay. So if you take out shelter, we already went over this. My bad. This is the next one. Shelter prices are lagging real-time rent. So if you do, so we took out shelter. We know we're under the Fed's target. The Fed should be pausing based off this data. But if we actually just look at shelter, there's two things. There's the Fed's very lagging indicators that can lag up to 1 year. And then there's actual apartment rents. There's Zillow, there's Redfin data, which is more real-time prices, rents, and all that shelter prices, right? And so when you look at that real-time data, it's collapsed significantly. It peaked back in November of 2021, but the Fed's data is taking a lot longer. So in real time, inflation is under the Fed's target, right? If you take out shelter, or if you add in shelter rents, right? Real time data, it's pretty negative. The Fed knows this. They've talked about it. They know this. They understand that. So we don't know when they're going to actually factor it in, which is why I think there's going to be a big surprise this year that the Fed can actually cut rates to remain in restrictive territory. Remember, right now, if you look at headline CPI, Fed funds is at 5.5. CPI is, let's say it's at 3. That means you're at 2.5%. You have this 2.5% range of restrictive territory. That's a lot of restriction. At the beginning of the year, we were the opposite, right? We were in very easy mode. This is restriction, 2.5%. So if CPI drops to 2.5, now you're at 3% restriction. Well, the more restrictive they come, we just saw the Fed minutes, there's a risk of tightening too hard. As long as CPI comes down, as long as inflation comes down and makes more progress, then that means rates or the restriction is going to get tighter. It's actually getting tighter as prices fall. It's working to tighten the economy as it sticks at 5. It's not like it's at 5.5 and it's just there. It's tightening at 5.5. So I think there's a very good chance that if CPI keeps falling, that they're going to maintain that 2.5% restriction by lowering rates. They can drop, let's say if CPI goes to 2.5, then they can drop rates to 5, and it's still at 2.5% restriction. Does that make sense? If it doesn't, I don't know what to say. But I think we can cut rates this year. It's possible. We need oil to go lower though, right? If CPI gets down. So that's pretty much it. Let's get through. Let me see. Look at oil, RSI. I think that's it. I think that's about it, right? And then crypto is gonna fly if that's the case. So technical wise, I got to speed this up here. Don't forget to like and subscribe if you have not yet, right? I appreciate you guys on here. Leave me comments on YouTube if you have further comments or you disagreements or you want to trash what I'm saying. I love it. I want to hear, other opinions, whatever it is, or you have really big questions. Let me know. So technically, look, S&P is falling into support. Looks really good. I'm just going to go over this real quick. Qs, right? The Qs. And can we see this? Yeah, we can see this. Okay, good. The Qs, right? Technology on trend. We're just pulling into the trend at support. We're at support in the trend. Great. Let's go to the Dow. The Dow's pulling into the trend, right? At support. We're still going higher. IWM isn't even at the trend yet. So that one's a little different. It might have a little more room to fall, but there's some support right here. You can see it at about 180, right? Equal weight. This is S&P equal weighted average. And a couple of podcasts that I was listening to were saying that a lot of investors are interested in the equal weight more so because they don't want to be exposed to the Magnificent Seven, right? Apple, Amazon, Google, Facebook, Tesla, Nvidia. They don't want to be exposed to things that exploded. Although at this point, that's already changed because Tesla's down 26%, right? So I think there's going to be a tech rally. But either way, equal weight is pulling into the trend, still moving higher. Look at the RSI. The RSI is also oversold. So we're getting oversold reversal signals with a pull into the trend, right? I think the market's going higher from here over the next couple of weeks, unless you have a surprise. I always say that. Okay, S&P, same thing, right? Bitcoin, same thing. But Bitcoin's not trending higher. It's kind of holding that support level. That's what Bitcoin's doing. It's kind of holding the level. That's a big level, 25K. But look at this. Look at this. This sell off, right? Not sell off, but look at this RSI. We haven't been here since. I mean, we were close to this level really in 2022 when we first dropped, but it did exceed that level a little bit, right? It exceeded 2022. Okay. Actually, hold on. Let me go to the restroom real quick. I drink a lot of liquid. I'll be right back. We'll continue on. All right, I'm back. Don't eat carbs, small bladder. You know how it goes. A lot of liquids. Okay, so yeah, Bitcoin looks like it's on track. I think it's looking pretty good here. And I think that pretty much covers most of what we're seeing here on the market. Some of the commentary, I know there's some commentary that I might have looked at. Where is it? Is this the commentary? No, this is the commentary. Good news is bad news. Okay, so here's and I sent this out. I might be sending this out on a weekly basis just to get some of the professional analysts. What are they saying? Right? What are some of the professional analysts actually saying? And I'm going to read some of that for you. You can read through the report. I'm not going to read everything, but here's what they're expecting, right? Everyone's expecting a correction in the coming months, which could result in a market bottom. Why is that? Because people stop selling and they're expecting the bottom to buy it. So they stop selling. Same thing when the market's going up a lot and everybody's like, well, it's going to have to slow down. Nobody sells because they're afraid that they sold the top. They're afraid that the market's going to keep going up. So they wait to sell for the signal and the market just keeps going higher. It's a very psychological game there. So I think it's, we're going to bottom out here. Higher bond yields are simply reflecting a strong economy. So bond yields aren't climbing. Yes, they're tightening financial conditions, but bond yields are not climbing because inflation is going up. They're climbing, and that's what they usually do. They're climbing because growth is up. So it's actually a good reason why yields are up. even though you might feel like, oh, this is bad, things are going to collapse. The recent rise in long rates is slowing 30-year mortgage demand. We already talked about this in the housing market, right? It's stalling housing market demand. Home builder stocks are slowing, maybe slowing from the rise in supply, which is positive for consumers and negative for profit margins. I didn't really agree with that. Better earnings expectations to drive stocks higher in Q3 because GDP is up. China may slow global growth unless policy revamps. Now, this is an important one. I think China definitely is going to start stimulating again. I think China is going to start pumping again, and I'm going to keep my eye on Chinese liquidity, and in general, well, this is Fed liquidity, but I'm going to keep my eye on liquidity for China. Here's another thing you want to keep your eye on. This is the money market fund. Money at the Fed. As it goes down, that money is actually going into the Fed, and when it goes up, it's fueling the market. Right now, it's coming back down. So the Fed holding rates higher is attracting money market funds. It's attracting, because what it is you're getting paid a certain percentage, so it's attracting them, right? It's attracting fixed income investors. But if it rises, they're actually leaving because they see a better opportunity in risk assets, right? I'm not going to go over that completely, but you can see the matchup, right? As it stalls, crypto stalls, right? Tesla stalls and rolls over. It's less liquidity into the market, right? What else is it? S&P, QQQ, right? As it stalls, QQQ stalls. So they're kind of a one-for-one match. Oops, I screwed that one up. And so I'm keeping my eye on that liquidity. I think China keeps printing. They devalue their currency, and we go higher from here. China is going to bring the market down if it can't bounce back. That's a real concern. China could bring down the market. You know, with the U.S. GDP this strong, I don't know if China really brings it down. You could be right, but in general, oh, you know what? This isn't even on. I just realized that my mic wasn't even on. So wow, this mic wasn't even on. That's probably terrible sound. You guys should have told me. Damn it. Pisses me off. Oh well. I don't think my mic was on. How'd you guys hear me then? Wow, I can't believe I made that mistake. Do you think we can get another commodity rally? Here's the questions. Here we go. Can we get another? Yes, we probably could, but look at commodities. Check out commodities here. All right. Copper pulling into the trend. So let me remove this chart. Okay, copper's pulling into the trend. Bottom of the RSI. Yes, it could, right? So we could get another commodities rally for sure. I mean, look at copper. Copper looks good. If there was one commodity that I would bet on, it would probably be copper, because you're about to get the business cycle turning back up. And when it does turn back up, when it does turn back up, you should definitely get a rally in commodities, but you need the global PMIs, the manufacturing part of the business cycle to turn up with it. So watch the ISM and watch copper. Okay, does it reignite inflation? Only if supply chains are broken. That's my view. Only if supply chains break down. Well, TikTok is good because I don't use the mic on TikTok. It's the YouTube video, which pisses me off. I knew something was off. I missed it. It's okay. So yeah, do we get another rally? Well, possibly, but I think for it to be sustained, you need China to come back online. You need the global manufacturing indexes to come right back. Okay, cool. Well, I hope I sound good. All right. Any other questions? I'm going to give it a couple minutes. I know there's a lot of questions here. My mind is mostly wrapped up in where's the bottom of the S&P. Crypto, I'm not worried about. I mean, the Bitcoin ETF is going to set things off. I would say this: if you're new, if you can save $450 a month, okay, talking to some of you other guys, you can save $10,000 in 2 years. That's it, $450 a month. That's what you get paid every 2 weeks. That's no $420. You get paid every two weeks. Save $210 and just save it up. I'm trying to throw some personal finance here. Stop spending on stupid stuff. Save your money. Start investing now. We're at the bottom of the cycle. Whether it's Tesla, whether it's Palantir, whether it's Chainlink. Well, that's a little more risky, but I'm big on Chainlink. Ethereum, Bitcoin, or something else. Get invested regardless, right? Get into the market. You can't beat inflation. Wages don't rise fast enough. So 450 a month, that's 10K. You can be a millionaire in 10 years if you navigate the market correctly. How do you do that? Can you spend a whole lot of time studying? No, but I do. And then I'm going to deliver it to you. You ask me the questions. Apple, if the new iPhone is a flop, then SPY is going to bleed hard. Probably true. Guzman, probably true. Hey, that's my grandparents' last name. That's probably true. If Apple rolls over, we're probably in trouble. I just don't think it's going to happen. Apple is winning on services, right? People, right? Just think about this. And let me just throw it out to you. Am I biased? 100% I'm biased because I think the market's going higher. But I'm aware of my bias. I'm not blinded by it. Okay, so what I think is the global economy is actually picking up as soon as they print money in China, going higher, Japan going higher. They all buy iPhones. They're going to stimulate more demand for iPhones. And if it is true that Apple kind of messes with their network so that people can recycle their iPhones, there's going to be more buys on it, right? There's going to be more demand for iPhones. And GDP is up right now, so people are spending and they will buy more phones, especially going into the what do you call it? The rebound, especially if rates come down, right? If rates pause here and they come down in the bond market. So am I going to be right? I don't know, but I do think Apple will bounce back. Their services are actually bouncing back too. They have the strongest services they've had for a while. They have very strong margins. And I think Apple, let me go to Apple stock. They just sold off tremendously, right? They sold off market cap so much. So I think Apple is going to find a bottom here. Let's see what they look like. RSI, look at Apple's RSI, oversold. Every time we got that oversold on RSI. Look at here. Well, let's go back in the past. Oversold, near oversold, there was a bounce, right? We didn't go higher, but there was a bounce. I'm just talking about the bounce. Oversold, bounce. Oversold here, bounce. Oversold here, bounce. So I believe Apple will bounce. Mark my words, unless there's a surprise over the next 2 to 3 weeks. I'm expecting Apple to bounce back above, maybe not above all-time highs, but they're going to bounce. Apple's going to bounce here. It has better credit than the US, so it's like Apple's a safe stock. People love Apple. They love to trade Apple. They love to sell calls. They love to sell puts, whatever it is. I don't think Apple is going to roll over. I could be wrong, but I think you need the macro to really turn over for that to happen. If we get another here, next comment. If we get another oil spike, oil and commodities, spike in oil and commodities, what would that mean for inflation? 1970s all over. Yes, that's why I said the biggest risk is that oil gets above 83.50. That's where I'm worried. If oil starts to jump and commodities start to jump, and you don't have strong supply chains and you don't have more, productivity, then we're going to be in trouble. But I happen to think that manufacturing demand is actually just even. It's not really climbing. It's not really falling. I think it's break even and the supply chains are strengthening. Okay. I think AI is going to help revamp that too. Okay. So we got to track it, but for the most part, look at fiscal policy, right? Look at, the policies coming out of the White House, which are building more infrastructure. So that's going to feed GDP. And it could be inflationary over the long run if the supply chains don't get fixed. So they better make sure that capital is going into producing more. If the US just consumes without producing, we're in trouble. But look at China, they produce a lot. So but you're right. If oil and commodities break out, probably a new inflationary cycle. Here's another thing to think about, Bukowski. From 2002 to 2005, that was globalization. Commodities exploded because China was becoming a superpower and there was no inflation. Okay, there was no inflation when China exploded. So what does that tell you? And this was let me see if I can see the chart, right? Let's go to copper. Where's copper at? We didn't have any inflation. Let's go to copper really quick, because this is a good point that people make about commodity. It's all about the supply chain. It's all about productivity and supply. The more you produce, prices go nowhere, right? They can even go deflationary if you produce too much, which is good because deflation isn't negative if you're producing a lot and there's demand for it. It's bad when there is no demand, when nobody's buying it, because then you're creating excess inventories and nobody buys it, prices go lower. But if people are buying it up, you're okay, right? It matches your revenue. So where's copper at? Where's copper? Copper. Oh my gosh, dude, I don't even know where my charts are at. Here we go. So 2001. Watch, I'm wrong here. I'm pretty sure. I've studied this. Maybe I'm wrong. Oh, look at this. Here's copper, bro. Look at this. Copper went from. Let's just go to the low in '01. Okay, in 2001. Let's go from 2000. Actually, we'll go to 2002. We'll go to 2000. So from 2002, copper at 65 cents, according to this chart, all the way to 2007, it went up 500%, and you had no inflation. Right? If you go to oil, maybe you go to natural gas or oil, they all went higher. My point here is commodities don't equal inflation unless supply chains suck, unless supply chains are bad. So keep that in mind too. Aluminum, all that stuff. Just keep that in mind going forward. It could be inflationary, but it's really about the supply side. Are you an Android or iPhone guy? I used to be an Android guy until when I was a teacher back in the day, my students made fun of me. Why don't you have Tesla stock? You're up a lot, because I used to teach them about stocks, and they told me I need to get an iPhone, and so I got an iPhone. So now I'm an iPhone guy. I was thinking about getting in a call before the release of the new iPhone. I wouldn't do that, honestly. I wouldn't do that for. I mean, Apple, the RSI is down a lot. I just think there's better risk reward, and if you want to get a call, this is not financial advice. Get a longer term call. Look 6 months out, okay, just to play it safe. If you're not a trader. This is just what I'm thinking. What I would do, think 6 months out to 1 year out, buy call to see what happens, right? On a very oversold RSI, you might be good there. Let's see. Are we going to have a recession? No, we are not, Mr. Mary Chang. We're not going to have a recession. So far, it could happen if there's like some kind of like if something bad happens, a surprise. We can't predict black swans. No recession. There's no recession right now. GDP is climbing extremely fast. It keeps getting revised up. No recession. And the government is still spending. And the infrastructure bill is still coming in, right? And the Inflation Reduction Act still hitting the economy. So no, I don't see it. It's like a cycle. So many similarities. Yes, it's like a cycle. I think Apple should buy Disney. What do you think? I guess. I heard that Apple or Disney is going to buy ESPN. Or wait, no, Disney already owns them. I heard somebody's going to buy ESPN. I don't really know, to be honest with you. But should they buy Disney? I don't know. They have a lot of cash on it. I think what they should buy is Bitcoin. That's what I think they should buy. And I also think Apple might be, I heard the most realistic thing, Apple might buy Lucid to get into the electric vehicle space. What do you think about Palantir? Look at Palantir's pullback. That was your opportunity. Palantir, best AI, bar none, pure AI play. People don't really know about it. Go read 0 to 1, Peter Thiel. Palantir, best AI play in the market. Still not realized by Wall Street. When they turned to profit early, they exploded. Now they're pulling back. Palantir, if you go, I wrote about Palantir in 2020, I believe, 2020 or 2021, about how bullish I was on Palantir. Now, yes, it sunk a lot. It went low, but yes, Palantir, it's really hard to explain because it's a software engineer AI thing, but definitely best AI. I think pure AI play. And it's still climbing its feet. The RSI, it's almost oversold. I think it's near buying. Look, at last time it was this low, it exploded after that. So I like Palantir 100%. Is the yield curve not under 0 on the 10-year on TradingView? That said the other recession. Let me try to read this. Is the yield curve not under 0? So the yield curve, here's the yield curve. Let me get to the yield curve. Where's the yield curve at? 10-year yield curve. So this is the 10-2. There's a bunch of yield curves, but this is the 10-2. You want to make sure, yeah, it's regular. This is the 10-year. It's 0 is, let's see, it's well under 0. Wait, let me see if I can make this look better. Okay, so the yield curve is well under 0. Why does it look like it's on a log chart? This should not be oh yeah, it is on a log. There we go. Okay, not on the log. So there's your 0, right? Yield curve is beneath 0. Now the yield curve is steepening, so it's going back up. This is usually when the recessions start to hit. There's two ways that this plays out. Okay, we got no recession. Everybody's like, what? Things change in the market. Data feed, like the yield curve is typically a signal of something. But now we have instant data, really quick information. We live in the age of information. And the last recession, big one, was 08, and the yield curve inverted. 2018 a little bit, but now the market has changed so much. And plus with the pandemic stimulus and government spending, I don't think it's giving you a great signal. There is a recession in manufacturing. We've seen it. There's a rolling recession. It was in housing, financials. The banks fell apart and the Fed stepped in. So I think it is now starting to steepen. It is below zero, right? And it steepens. And this is usually when you get the pain, but we're not really seeing it and the reason why this is painful is because banks hold a lot of short-term debt, and that short-term debt devalued considerably over the last 2 years. It got destroyed. It fell a lot. So when your debt falls, all your lending is now at risk. That's the banking crisis, right? Your lending is at risk. So as this thing reinverts, there's two ways it could happen. If short rates come down, which means people are buying short-term bonds because they're now optimistic about the economy. Okay, I'll go ahead and lend at 2 years, at 1 year, at 3 months. I'll go ahead and invest in the next 2 years. I don't see a recession. As it goes up, right? That's a good thing if the 2 year drops, meaning there's more demand into the short-term bonds, right? But the bad scenario is that it's going up because it's a spread. It's going up, not because people are buying the short-term end of the curve, but because the long end is going higher. So it makes it look like the curve is steepening. So this is not good. And we're getting a not good signal because long-term 30-year, 10-year yields are climbing. So that's a bad signal, but we might be at the peak. We'll see how it continues. Hopefully the rest of this climb has to do with the 2 year actually dropping, people coming in and buying the short-term bonds to lower those rates. Hopefully that's the case. Do I look at the yield curve? I do, but I'm more privy to the yield curve, like this big conglomeration of what's happening. I rather just look at the 2 year, the 10 year, the 30-year yield, and I rather just look at that. I rather look at the yield curve in general versus the whole yield curve versus the yield curve inversion. And this is only 10-year, 2 year, and there's a lot of misconceptions about it. And I'm learning myself. I listen to a lot of people who don't agree on it. And the guy who actually created the yield curve said this is a false signal. What do you think about Intel? Is super low. I think Intel will be good long term for sure. It's not going to grow as fast as Nvidia or AMD, but it's a solid play. Is it a great trade? No, I think AMD is the best trade and possibly Nvidia because AMD has a lot of room to run. It's forming a big falling wedge pattern. Watch AMD. So I think as a trade, AMD looks better. It's a very fast mover. It's also more risky. Intel is just a lower risk play. AMD is a bigger risk play, bigger risk, big reward. Intel is just a lower risk play. INTC doesn't move as much, right? But it's pulling into support. It'll go higher. It'll go higher eventually, but you don't want to trade options, I think, with Intel. I don't think you want to hold long-term options with Intel because it might consolidate for like 6 months. Versus AMD, that thing explodes when it explodes. Make sure they're oversold when you buy them. Let's get back to where let's see, 10-year higher pop in Dow Jones. If the 10-year goes higher, do we see a pop in the Dow? If the 10-year goes higher, the benchmark for rates all go up. Does the Dow pop? Not necessarily. I think if rates on the long end stay higher, then the Dow could outperform. If short-term rates come down and long-term rates stay high, then I think the Dow can start to outperform because the Dow is going to be the Dow is going to benefit on lower short-term rates, where the Nasdaq is going to benefit also on short-term rates, but the Nasdaq is going to get hurt more by higher long-term rates, where the Dow maybe not as much, right? But I still think those are one factor. That's one variable. The other variables were like when the catalyst for AI is so strong, Qs are going to outperform. In earnings, right? Earnings are still your biggest catalyst. All else held equal, higher 10-year slows down the Qs. But if it's not all equal, it doesn't really matter. That's my thoughts on that. I'm trying to figure out, why can't I see the time? Oh, we're 1 hour in. Okay, cool. So hopefully this thing didn't lag too much, but I do got to get going. Okay, I appreciate you guys jumping on. I got to get going. Last day here, then I'll head back to Phoenix. I'll be back and we'll get back on our grind. And I have some videos I will pump out eventually for the Compound. I like the Compound podcast. Anyways, I do appreciate you guys coming on. You guys remember, stay blessed, get your workout, enjoy your weekend. Stay blessed, right? Keep a strong mindset. Help the people around you If you see somebody in hand, give them a hand, right? Get your good sleep. I haven't been getting good sleep, but it's for, family purposes. Get good sleep. Lower your alcohol intake or don't drink at all. Make yourself better. Oh, I'm actually driving. Well, my girlfriend's driving. I don't drive because my back hurts. But I appreciate you guys. Thank you. You guys take care. I'll see you on Monday. I will be live Monday. If you're not subscribed to the newsletter, check it out. Okay. And that helps me out too. It gives me a little ego boost. You know what I'm saying? And plus, I'm trying to grow the channel. I want to do this forever. I don't want to just do it, and fail. I want to do it forever. So help me out there. If you want, subscribe to the paid newsletter. You're basically giving me a donation. And that's my goal, is to really, drive this. So I got to figure that out. But either way, it's, this is content for you guys. I'll be on Monday. You guys stay blessed. I'll catch you later. Stay blessed. Keep a growth mindset, right? Keep a growth mindset. Jesus is king. Let's go. Actually, I'm going to put music on for this one to end it out. Haven't done it for a while because my stream deck doesn't work. I'm still waiting for the technical guys to fill it out. So I'll just do it like this. All right. See ya.